Financial Accounting, 6th edition, by Libby and Short. Chapter 1. Financial Statements and Business Decisions. Individuals and groups who provide the initial capital to a business are called investors. Creditors provide the company with resources, but do not own a share of the company. For example, a bank may lend funds to the company that must be repaid in the future, along with interest. The bank is a creditor of the company. A supplier may sell parts to a company and not require payment for 30 or 60 days. These suppliers are also considered creditors. Most companies hire managers to oversee the day-to-day operations of the business. The managers are responsible to the owners of the company. For a manufacturing company, business operations begin when materials are purchased from creditors and workers paid for labor. The materials and workers are used to manufacture a product. The product is sold to customers of the company. Finally, cash is collected from the customers for the product sold, which allows creditors and workers to be paid. The accounting system begins by collecting and processing financial information. This financial information is organized into reports that are distributed to decision-makers. The decision-makers may rely on the reports to make certain important determinations about the future. A good accounting system produces information for financial reporting to external decision-makers. Those decision-makers include investors, creditors, suppliers, customers, union representatives, and all other interested parties. The system also should be capable of producing managerial reports that are used within the company to make determinations about pricing, production, quality, and numerous other day-to-day activities. In the process of accounting, we use accounts to help us organize information about various transactions. These transactions can be both external, events with parties outside the business, or internal, that is, events that take place within the business organization. Companies usually publish 4 basic financial statements as follows. 1. On a company's balance sheet, all resources owned and amounts owed are listed in order of liquidity. The difference between the resources owned and the amounts owed represents the stockholders' equity in the business. 2. On a company's income statement, all the revenues earned from sales to customers are listed, along with the expenses incurred to produce those revenues. 3. On a company's statement of retained earnings, accumulated net earnings less the dividends paid to owners represent reinvestments in the core business. 4. On a company's statement of cash flows, all sources and uses of cash are listed. Cash is generated by the company's operations. Cash is spent on investments in buildings, manufacturing equipment, and other assets. Financing activities involve amounts borrowed from long-term creditors and sale of stock to owners. The basic accounting equation shows what we mean when we refer to a company's financial position. The economic resources, assets, that the company owns, and the sources of financing for those assets, creditors and owners, are always equal. Assets are economic resources of the company that have some future economic benefit. Liabilities are the company's debts or obligations. Stockholders' equity indicates the amount of financing provided by owners of the business and earnings of the company since inception. As accountants, every transaction we deal with affects at least 2 accounts. As we record the transactions, We must make sure that the accounting equation remains in balance. Here is a list of balance sheet accounts that are grouped as the assets, liabilities, and stockholders' equity. In this course, we will discuss all of these accounts in detail. When a formal balance sheet is prepared, it has a 3-line title. The first line contains the name of the company. The second line is the name of the financial statement, in this case the words balance sheet. The third line is the specific date of the balance sheet, for example, at December 31st, 2009. Note the 3-line heading for our balance sheet. In addition, MaxiDrive shows dollar amounts in thousands. When preparing the balance sheet, we can see that the basic accounting equation of assets equal liabilities plus shareholders' equity holds true. These two lists contain typical revenue and expense account titles that we would likely find on the income statement. As with the balance sheet accounts, we will discuss each of these revenue and expense accounts as we move through the course. For now, expenses represent the dollar amounts of resources that the entity used to earn revenue during the current period. When revenues exceed expenses for the period, the company has earned net income. If expenses are greater than revenues in the period, the company incurred a net loss. Net income normally does not equal the net cash generated from operations. When a formal income statement is prepared, it has a 3-line title. The first line contains the name of the company. The second line is the name of the financial statement, in this case the words income statement. The third line is the accounting period covered by the income statement, for example, for the year ended December 31st, 2009. While the balance sheet has a date for a point in time, the income statement covers a period of time. Here is an example of an income statement. Notice our standard 3-line heading. On the income statement, we subtract total expenses from revenues to arrive at net income. This income statement is for a 1-year period. The purpose of the statement of retained earnings is to report the reinvestment of earnings from the company gained during the current period, less the dividends paid to shareholders of the company. When a formal statement of retained earnings is prepared, it has a 3-line title. The first line contains the name of the company. The second line is the name of the financial statement, in this case the words Statement of Retained Earnings. The third line is the accounting period covered, for example, for the year ended December 31st, 2009. Like the income statement, the Statement of Retained Earnings covers a period of time. Some companies show dollar amounts in thousands or millions. Here is the Statement of Retained Earnings of MaxiDrive Corporation for the year ended December 31st, 2009. On the Statement of Cash Flows, operating activities involve the cash provided and used in the normal business operations of the company. This section of the statement includes cash collected from the sale of products to customers, cash paid to suppliers for materials, and to employees for the labor to manufacture and distribute the product. In addition, we show cash paid for interest and taxes. Investing activities involve the purchase or sale of long-term productive assets, the lending of monies to others, and the receiving principal payments back from those loans. When we purchase a long-term productive asset, it's a cash outflow. When we sell a productive asset, it's a cash inflow. When we loan funds to others, it's a cash outflow. When we receive principal payments on those loans, it's a cash inflow. Financing activities involve borrowing and repaying amounts from financial institutions and the sale or repurchase of the company's stock. In addition, the payment of a cash dividend is classified as a financing activity. When we borrow money from a financial institution, it's a cash inflow. Repaying the principal amount is a cash outflow. When the company sells stock, it's a cash inflow. If the company repurchases its own stock, it's a cash outflow. The payment of cash dividends is always a cash outflow. Notice that our three-line heading contains the name of the company, the name of the financial statement, and the time period covered by the statement. In addition, MaxiDrive shows dollar amounts in thousands. The income statement, statement of retained earnings, and statement of cash flows cover a period of time. Let's look at another example to demonstrate the relationships among the financial statements. Net income, reported on the income statement, flows to the statement of retained earnings and increases the account balance. In our case, the $7,000 net income appears on the statement of retained earnings as an increase. Ending retained earnings from the statement of retained earnings is one of the two components of stockholders' equity on the balance sheet. The change in cash of $8,500 is added to beginning cash balance of $5,500 to arrive at end-of-period cash balance of $14,000. The end-of-period cash balance appears on the balance sheet. There are three basic types of notes. The first type provides descriptions of the accounting rules applied in the company's financial statements. The second presents additional detail about a line on the financial statement. For example, it is common to find a note that describes the details of a long-term debt agreement. The last type of note provides additional financial disclosures about items not listed in the financial statements. For example, a company may lease rather than purchase major pieces of machinery and equipment. Marketing and credit managers use financial information for purposes of preparing budgets or for determining whether or not to extend credit to a customer. A purchasing manager may use a supplier's financial statement to see whether or not the supplier has the resources necessary to meet the company's demands. Employees and union representatives may use financial information in contract negotiations. To have effective communication, those receiving the information must understand what the sender intended to convey. Informed decision-makers need to understand accounting rules and accounting measurement practices to understand the message conveyed. Luca Pacioli, an Italian monk and mathematician, first published the elements of our double-entry bookkeeping system in 1494. Until the stock market crash of 1929, most companies decided on their own accounting principles. There was little uniformity or comparability of accounting information. The Securities Act of 1933 and the Securities and Exchange Act of 1934 established the Securities and Exchange Commission. The Securities and Exchange Commission has the ultimate authority for establishing accounting rules and procedures. The Securities and Exchange Commission has worked closely with the accounting profession to work out the detailed rules that have become known as GAAP. Currently, the Securities and Exchange Commission permits the Financial Accounting Standards Board, FASB, to formulate generally accepted accounting principles. Companies incur the cost of preparing financial statements. These costs must not exceed the benefits received by the company. Companies wishing to sell their stock to the general public must issue financial statements in compliance with generally accepted accounting principles. The preparation of financial statements is often necessary to determine bonuses received by managers and employees. On the negative side, widely available public information gives a competitive advantage to other companies in the same industry. Since 2002, there's been a substantial movement to develop international financial reporting standards. This movement is controlled by the International Accounting Standards Board. It is an extremely difficult process to establish accounting rules that work in almost all industrialized economies. While some progress has been made, the International Accounting Standards Board still has a long way to go in establishing international accounting standards. To ensure the accuracy of the financial information generated by the company, management must maintain a system of internal controls, employ the services of an independent outside auditor, and form an independent committee of the board of directors to review these two safeguards. The independent auditor is hired to express an opinion as to the fairness of the financial statement presentation. Independent auditors are responsible to the general public for the opinions they render. An independent audit is designed to ensure that the financial statements conform to generally accepted accounting principles. The independent auditor examines the underlying transactions to make sure that the compliance with generally accepted accounting principles exists. Finally, the independent auditor must reach some opinion as to the fairness of the presentation of the financial statements. The American Institute of Certified Public Accountants requires that all members adhere to a professional code of ethics. Like physicians and lawyers, a CPA's reputation for honesty and competency is his or her most important asset. Also, like physicians and lawyers, CPAs are liable for malpractice. End of Chapter 1.